All right, everybody, recorder's going. It's Mike Shorr here. There was a question about advanced auto parts, and I believe it was Bill, and he's bullish on the stock. I happen to be too, and I was saying that that there is a technical setup where I said IB, which means inside bar, in advanced auto parts, and I'm waiting for Monday to see if it actually comes to fruition. Let me make this a little bit bigger. Let's knock this down to the last 3 months. Okay, so we see over here, one, I like the fact how it went and visited the 200-day moving average, or this is the 50-day moving average, rejected off of it. But now today we have an inside bar that is setting up IB. So meaning that the high of today is lower than the high of yesterday, and the low of today is higher than the low of yesterday. So this bar is inside of this bar, which is not significant for today, but for Monday it is, because the trigger price is if we take the high of this day, which is today, 170.73. Let's see if I can find a calculator here. So if today's high holds at 170.73, and we get 1% higher than that on Monday, so 172.44, that's my trigger price to get long. And then once that happens, then we can figure out on Monday what exactly we want to do. If you want to say, you know what, I'm bullish for different reasons, Mike. I like that you're bullish as well, but I'm bullish for different reasons, and I want to act today. Well, we certainly can do that. So first thing we want to do, and what came up was that he's looking at the regular May butterfly, the 170, 180, 185. 170, 180, 185. So that is a $10 wide call spread on the front and a $5 wide call spread on the back, trading for about $3. Well, let's see if that's a reasonable place. Let's make this a little bit smaller. Now that you can see what the technical reasons that we were looking for over in the main trading room, not Scott's office, with Pat Hammond and Charlie Moon. We can see where's a reasonable place to target, right? Because we could end up, not maximizing ourselves. So using the options trading tool, which is available in the documents tab for those that are new, we need 3 pieces of information here with advanced auto parts. We need the current price, which is 170.20. We need our expiration date, which we said is regular May, and we need to know what the implied volatility for that is, and which happens to be 25.97, just shy of 26%. So that is saying to the upside, giving us a price distribution. Over here on the left is a standard deviation. Over here on the right is I happen to be using the 59% confidence interval. So targeting somewhere around 180 seems to make a whole lot of sense. So I like the strikes that you picked. Makes sense to me mathematically. Makes sense to you I don't know how you came to that, but we at least agree. Okay, so if we do look at that 170, and we only have $5 wide strikes here, so if we go out to regular May and we do, I believe you said the 70, 80, 85. 70, 80, 85. Now realizing you're buying an at-the-money call, slightly in the money at this point, but it is trading. The market is 225, 325, which makes 275 mid-market. I think you said you thought you could do it for about $3. I think you could definitely do it for $3. You probably could do it a bit cheaper. I'm going to use 275 as my. So we go here, and we have the 170, 180, 185. Buy one, sell two, buy one. Ideal place to go. Our target strike, 180. And we said that we had to pay $2.75 to do that. So if we do go to our targeted strike, which is the best place for it to go, we're going to make $10 on this first leg of the broken wing butterfly, and then everything else is going to be worthless. The 80s are worthless at 180, the 85s are worthless at 180. So we can make $10 on our spread. We have to pay $2.75 to get in. That means that the net between the two is $7.25. 7.25 divided by 275 is 2.64 to 1. Obviously, anything below 170, we're giving away our $2.75. Anything 185 and above, well, we have a we have a $10 wide call spread that we've maxed out, and then we have a $5 wide call spread that we've maxed out as well. So the net between the two, we're going to make $5. $5 minus the 275 is going to give us a net of 225. We're actually getting less than 1 to 1. Now, of course, if you go blowing through your strikes, that's not the best thing in the world, but at least you don't lose like in a conventional butterfly, and that's part of the reason for the fly. So now you have to ask yourself, okay, is there anything else that we can do here that makes any sense as far as the strikes are concerned? And the thing is, we only have $5 wide strikes right now, so we could lower the cost basis by buying the 175s, but then we would have to target 185, and I think that that's too aggressive. So I agree that if you're going to do something butterfly-wise, that this might be the way to go. The other thing to do is, well, can we do something other than a broken wing butterfly? Well, we could do just a straight vertical spread. We can do the 175, 180, still targeting that same place. That's going to cost us $1.25. So now let's do that risk reward. Clear these out. So now if we do the 175, 180, buy one of these, sell one of these, and that's going to cost us $1.25. Same place we want to go to is 180. Well, now we're getting 3 to 1. But of course, we have to get above 175 for us to start making money or start making our debit back. So then it becomes a matter of taste and of methodology. Do I have a firm belief that we're going to 180? If I do, well, then this is, I think, a little bit better of a job, the call spread. If I think, hey, it's possible that we go to 180, but we could also just grind up and never really get much above 175, well, then you're going to be better off with the iron fly. Excuse me, not iron fly, broken wing fly. So that's the way that I would approach both of those. So I am in accordance with you. We've been talking about it. It's on our watch list for Monday already. I'm not going to hop in until Monday. I don't see any pressing need. We don't have any earnings that we really have to worry about or anything like that. Okay, any questions on that? I like your analysis, though. I think I agree with most of it. I don't disagree with any of it. Oh, hang on a second here. Okay, good. Like I said, I think that you're right on with your analysis. And okay, anybody else unclear on any of that? This is a relatively short video. It's going to be around 10 minutes. But that was really it. Okay, good. Thank you for the questions. I'm going to be toggling back and forth between the two rooms. Any questions? If I don't get right back to you, I'm not ignoring you. I just probably didn't see it, or I'm doing something else. It's not like we're super busy, so I should be pretty attentive. But we are still in the New York Chicago lunch time, so I don't expect a whole lot to be going on for the next half an hour. So probably a decent time to grab yourself some lunch or a cup of coffee or anything like that. And anything else that comes up, please let me know. All right, everybody. Thanks for letting me visit, and I'll be talking with you soon.